I want to talk about how the 6-month T-bill, the yield is now around 5%. And if you look at the S&P 500 earnings yield, it's also around 5%. You know, it's the narrowest spread since around 2001. And so there's like income in fixed income again, and the equity risk premium is really expensive. And you know, the bond yields are rising. They're kind of blaring these alarms, but they're kind of falling on deaf ears when it comes to the stock market. You know, it's been resilient. And so why are risk premiums and these indicators remaining optimistic in the face of these yield spikes, and kind of this continuing hawkish rhetoric from the Fed? Like, these stock valuations are still pretty high. And we've seen this kind of bear market rally. Perhaps it's the beginning of a bull market, but we've seen this rally over the first quarter of 2023. And what do you guys make of it? Given that the yields are high in the short end, why wouldn't somebody just go into that instead of taking the risks and going into stocks?
Well, I'll just state my bias at the beginning, which is I think that the equity market is a historically flawed metric for analyzing the real economy. And I think the credit markets give you far more information. You see very wild volatility in the equity market that doesn't match the economic realities, and there's plenty of historical examples you can point to. But one of the things that makes a lot of sense to me, and I'll quote my green on this, was I think it is a compelling argument, is that an alternative way of looking at 2022 is to look at what effect on portfolio construction raising front end rates does. When you look at the beginning of the year and the Fed moved to that aggressive, once in 40-year hiking cycle that Nick was just talking about, what you tend to see is this sell-off in bonds, right, because of the hiked rates, and that money has to go somewhere for rebalancing purposes. So through most of the year, you saw the sell-off in bonds. What did that do? That pulled down the equity prices because you had to sell your equities to buy your bonds to achieve the 60-40 construction. And what that did, it caused this historically very negative 40-60 portfolio, 60-40 portfolio result, right? It's one of the worst years. I think you'll know the stat probably off the top of your head,
Centuries.
Sam, but yeah, in recorded history, whatever it is. That's fascinating to me, how the rather than an economic slowdown, because we didn't see one, right? We saw two very modest negative prints in real terms, but still quite hot nominally, very tight labor market. You didn't see the typical GDI was positive the entire year. You didn't see the typical hallmarks of a recession last year, but you still saw this violent sell-off. And I think that largely can be attributed to those sort of natural passive rebalancing aspects, which is the dominant force in our markets today, these sort of buy and hold investors with that balanced portfolio. So to answer your question here, like, why are equities holding in? I think that there are still real concerns in the bond market that can you see this, what I would call a capitulation move, at least at the front end, where you see these rates spike and go higher. And is the risk in the bond market still there in the near term for the next 3 to 6 months, right? Until you get sort of the recessionary dynamics that Nick was talking about, middle to later part of this year. Is it safer to hold equities, which at least the equities carry forward some pricing power, right? They can transfer some of those costs to consumers with the higher inflation versus holding out in bonds. So I think that may be a factor in play in why the risk premiums where it's at in the equity market.
When I think about the risk-free, 6-month T-bill yield at 5%, there are a couple things that come to mind. Number one is that we will have a crowding out effect. There will be the marginal investor that says 6-month T-bill at 5% is a great way to store my money, and I'll figure out what to do at the end of the term, or 1 year or 2 year, lock in that 5% yield. And that takes money out of, let's say, a risk asset like the stock market and puts it into the bond yield. And that is a threat for the stock market, for sure. Going forward, especially this crowding out effect. However, stocks and Bitcoin too both respond most importantly to global liquidity. And that's the regime that we've been in since 2007. It's a liquidity driven machine. And so right now, or let's just say in 2022, you had some of the worst liquidity dynamics and one of the greatest liquidity contractions that we've ever seen because of how intense the stimulus had been. But if we look to what's happening this year, yes, the Fed is still worried about inflation and hiking. And we have the ECB, especially, very worried, and their inflation metrics are actually peaking now, while ours peaked last year. So you have the ECB going tighter, but the rest of the world is now actually coming away from the tightening and into a more liquidity providing sort of stance. And I do think that the stock market, why is the stock market hanging in? Your question. I believe it's because the stock market is forward looking to better liquidity conditions over the next 6 to 24 months, not just what's going to happen in the next 3 months with the Fed or
Gotcha.
or that. And so when the curve is, again, back to the curve inversion, the curve in any curve inversion is a pricing in of future rate cuts, just mathematically speaking. And so that path of rate cuts is a liquidity boost for the markets. Stocks, I believe, are looking forward to that easing of liquidity conditions. And that's something they couldn't see last year. Hence the real intense decline in stock prices.
Nick, do you based on that comment, when you say they're forward looking, are they also forward looking to the likely recessionary dynamics you have, facing us in the housing market? I mean, you think what's your comment on that?
Yes, and that's the tug of war that we talk about in the stock market right now. Is that on the one side you have liquid, like empirically stocks rally on a Fed pause, but empirically stocks decline going into a recession and for the first few months of the recession. So those two dynamics are there, Joe. I'm right now reconciling it by thinking that the recession will be mild enough, and not that we're in for a stock market rally, but that stocks can hang in or see modest declines. Remember, stocks are still above 10% above their lows last year. So they're in a decent shape, and they could actually give some of that back in a recession and still not enter any crash formation, because the expectation is for boosted liquidity. So I'm not some raging stock bull here. And even when we look at Bitcoin is looking forward to or is forward looking on global liquidity. So Bitcoin is not at 50,000 because we're not expecting all this global liquidity, or that we're expecting some of it and macro will drive down risk prices. So there's the two sides, and you always have to balance what you think will dominate and assign probabilities too. So if your probability is 50% deep recession and 50% shallow recession, let's say that's your expectation, that the sum of those probabilities are going to spit out a stock market valuation for you. And I think that probability distribution right now is balanced enough to not get longer term investors to dump. But volatility exists at the margin. People are worried. We see that with all this choppy price action.
Yeah, Bitcoin's had a good 2023. I think on a risk-adjusted return basis, it's the highest asset class out of everything. So it's been going well. But I think, to your point, Nick, it's like a sponge of global liquidity, right? So we'll see if that continues moving forward.